Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Investing for dividends can be a great way to generate passive income, but it's important to understand the risks and factors that can impact your returns. In this video, we'll explore some key concepts related to dividend investing in more detail, including the advantages and disadvantages of investing for dividends, how to choose stocks and funds for your dividend portfolio, and how to monitor your portfolio and adjust your strategy over time. So, without further ado, let's make a start. One of the key advantages of investing for dividend is the potential for steady, passive income. Dividends are typically paid out on a regular basis, providing investors with a reliable stream of income that can be reinvested or used for other expenses. This can be especially appealing for retirees or other investors who are looking for a reliable source of income without having to actively manage their investments. In addition to providing passive income, dividends can also be a sign of a company's financial health and stability. Companies that can consistently pay dividends may be viewed as more reliable and less risky than those that do not pay dividends. This can be attractive for investors who are looking for that stable, long-term investment. However, whilst investing for dividends has its advantages, there are also some potential disadvantages to consider. One of the main disadvantages is that companies may cut or suspend their dividends due to changes in the market or financial difficulties. This can impact the income generated by your dividend portfolio and can result in a loss of principal if you need to sell your investments to cover your expenses. Another potential disadvantage is that focusing solely on high-yield dividend stocks may lead to an unbalanced and undiversified portfolio. It is important to diversify your portfolio to mitigate risk and ensure that you are not overly dependent on any one company or sector. This can also help to provide a steady stream of income, as some companies may cut or suspend their dividends due to financial difficulties, as we just mentioned. When selecting stocks and funds for your dividend portfolio, it's important to consider a variety of factors beyond just the dividend yield. You'll want to research the company's financial health, their earnings history, dividend payment history, and overall market trends to ensure that you are making an informed investment decision. One key factor to consider when choosing stocks and funds for your dividend portfolio is the dividend payout ratio. The dividend payout ratio is the percentage of a company's earnings that are paid out as dividends. A high payout ratio may indicate that a company is paying out too much of its earnings as dividends and may not be reinvesting enough in the business to support future growth. Another factor to consider is the dividend growth rate. Companies that consistently increase their dividends over time may be viewed as more attractive investments as they demonstrate a commitment to returning value to shareholders and may indicate a strong financial position. It is important to consider the diversification of your portfolio. Investing in a variety of stocks and funds can help to mitigate risk and ensure that your portfolio is not overly dependent on any one company or sector. This can help to provide a steady stream of income. Once you have established your dividend portfolio, it's important to monitor it on a regular basis and adjust your strategy as necessary. This can involve tracking changes in the market and company financials, assessing your risk tolerance, and considering changes to your financial goals or income needs. Keeping track of your dividend payments and reinvesting them as necessary is key. Reinvesting dividends can help to compound your returns over time, leading to long-term growth of your investment portfolio. This can be especially important for investors who are looking to generate steady, passive income over time. It is important also to continuously assess your risk tolerance and adjust your strategy as necessary. This may involve rebalancing your portfolio to ensure that it remains diversified and not overly dependent on one company or sector. It may also involve adjusting your investment mix to align with your financial goals or income needs. Finally, it is important to keep in mind that investing for dividends is a long-term strategy. While dividends can provide a steady stream of income, they are not guaranteed and can be impacted by changes in the market or a company's financial situation. For this reason, it's important to have a long-term investment strategy and to continue mentoring your portfolio and making adjustments as necessary. To illustrate the concepts discussed so far, let's consider a hypothetical example of a dividend portfolio. Let's say that you're looking to generate $1,000 per month in dividends, or $12,000 per year. Assuming an average dividend yield of 3%, you would need to have a portfolio value of approximately $400,000 to generate this level of income. To achieve this level of income, you could construct a diversified portfolio of stocks and funds with a mix of high yield and dividend growth stocks. For example, you could invest in a blue chip stock like Coca-Cola, which has a current dividend yield of around 3% and a long history of paying and increasing its dividends. You could also invest in a dividend growth fund like the Vanguard Dividend Growth Fund, which seeks to invest in companies with a history of increasing their dividends over time. To ensure that your portfolio remains diversified, you could also invest in other sectors and asset classes, such as bonds, real estate, or real estate investment trusts. By investing in a variety of stocks and funds, you can help to mitigate risk and ensure that your portfolio is not overly dependent on any one company or sector. Investing for dividends can be a great way to generate passive income and achieve your long-term financial goals. However, it is important to approach dividend investing with a long-term investment strategy and to consider a variety of factors beyond just the dividend yield. By researching and diversifying your portfolio, monitoring market trends and company financials, and consulting with a financial advisor as appropriate, you can create a dividend portfolio that helps you achieve your financial goals. It is also important to keep in mind that investing for dividends is not without risks. Dividend payments are not guaranteed, and companies may put or suspend their dividends due to changes in the market or financial difficulties. For this reason, it's important to have a long-term investment strategy and to continue monitoring your portfolio and making adjustments as necessary. Overall, dividend investing can be a great way to achieve your financial goals and generate passive income over the long term. By approaching dividend investing with a long-term perspective and a focus on diversification and risk mitigation, you can create a dividend portfolio that helps you achieve your financial goals and provides a reliable source of income over time. And that's it. Thank you for watching once again. I've been the Dividend Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.